The backdoor Roth. What is it, and is it right for you? A Roth individual retirement account IRA would seem to be off limits for many higher income earners, thanks to strict income caps on contributions to these accounts. However, some experts suggest another way into a Roth if you are willing to take the backdoor route. By this method, you open a traditional IRA, you make your desired contribution, and then, at a later date, convert the funds to a Roth IRA. Could it really be that easy to sidestep restrictions that have kept many investors from enjoying a Roth IRA's tax advantages? This strategy has gained popularity with some higher income earners, according to a recent research note by the Schwab Center for Financial Research. But the IRS has not weighed in definitively on what's allowed, so it's helpful to understand some of the issues, and it's highly recommended that you work with a professional accountant or tax advisor. Let's dig in more. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing impeccable. If you are doing as terrific as I am, we'll grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about the backdoor Roth. Is it really for you? Now let's talk about the appeal and limitations of a traditional Roth. With a Roth IRA, you get no upfront tax deduction as you do with a traditional IRA, 401k retirement plan, or other tax deferred accounts, right? However, you pay no tax on either principal or earnings when you withdraw your money, although you must be at least 59 and a half and have had the Roth for 5 years. There is no time requirement on when you have to withdraw the money from your account, if ever. And this is an appealing option for those wanting to leave the money to heirs, for example, as part of an effective estate plan. The trouble has been, of course, that Roth IRAs technically are only available to those whose annual income is below certain level, and the levels change every year. But they hover around 200,000 or less for married couples filing jointly, and 135 to 150 or less for single filers. And that's on the negative side. If you happen to be a high income earner, you may not be permitted by the IRS to take advantage of the Roth IRA. On the positive side, though, an increasing number of employers have added Roth options to 401k plans, so you can choose this option and contribute post-tax payroll deductions into a Roth 401k with no income limits. The bottom line here is that you also want to make sure that, but before you even choose a Roth IRA, even if you are below the income level, in other words, even if you qualify, if the IRS believe you qualify for a Roth IRA, you still need to make sure that whatever money you push into the retirement account fits within your budget, fits within your financial goals, fits within your risk tolerance, because the money in your Roth IRA or in 401k or in a traditional IRA, that money will have to be invested in the financial markets. And whatever stocks or bonds, whatever securities are selected by the portfolio manager taking care of that Roth IRA or the IRA, you want to make sure that their investment style and approach and philosophy fits within your goals and your objectives. Now let's talk about a two-step Roth conversion process. Many years ago, specifically in 2010, Congress passed rules to provide more flexibility and allow retirement savers to basically they want to match their financial goals with their retirement plans. And what they did was the congressmen and women allowed retirement savers to convert savings held in a traditional IRA into a Roth IRA, paying taxes on the distributions when they make the conversion. So some higher income earners use this approach in a two-step, very specific process. First, you want to open a non-deductible traditional IRA and make after-tax contribution. So for 2020, you are allowed to contribute up to $6,500 and $7,000 if you are age 50 or older. So make sure you file IRS Form 8606 every year you do this. This is important, folks. You want to file Form IRS form 8606 whenever you send your 1040 to the IRS. That's the first step. The second step is you need to transfer the asset from the traditional IRA to a Roth IRA. You can make this transfer and conversion at any point in the future. Some advisors suggest waiting a few months. What I'm trying to say here is it's very simple. If you are able to follow this two steps Roth conversion process, you can have the backdoor, you can access the Roth through a backdoor Roth scheme. Again, the idea here is you have to be very clear about what you need to do, and you have to be compliant. So file form 8606 every year you do this, and make sure you transfer the assets. Now, when you transfer the asset, and I'm going back again, I'm going to go back again to the important idea, the important chemistry you should have between your retirement plan and your financial goals. What I'm trying to say is that your financial goals, by financial goals, I'm talking about things like your risk tolerance, I'm talking about your asset allocation, and I'm talking about your diversification plan. And those three things should be reflected in your retirement plan. So whether you transfer from a traditional IRA into a Roth IRA, whatever journey you are doing right now, whatever journey you're doing right now to ease your retirement, to improve your financial stability during retirement, you want to make sure that that journey fits with your financial goals. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are also having a conversation here around the backdoor Roth, and I'm just telling you whether or not this is the right thing for you. And please, when we're talking about backdoor Roth, it's important to understand what we're talking about. What is the backdoor Roth when it comes to a Roth? You open a traditional IRA, you make your desired contributions, and then at a later date, you convert the funds to a Roth IRA. That's the backdoor route when it comes to Roth IRA. Don't forget that you need to pay the tax due. The conversion triggers income tax on the appreciation of the after-tax contributions, but once in the Roth IRA, earnings compound tax-free. Distributions from the Roth IRA in the future are tax-free as well, as long as you are 59 and have held the Roth for at least 5 years. Note though that each conversion amount is subject to its own 5-year holding periods as it relates to tax-free withdrawals. So if you have no other IRAs, figuring out your tax due will be very simple. However, it can be more complicated if you have other IRAs, because the IRS has something called pro rata rules, and those require you to include all of your traditional IRA assets. That means your IRAs funded with pre-tax deductible contributions, as well as those funded with after-tax non-deductible contributions, and you have to include all of your traditional IRA assets when figuring out the conversions taxes. Then you got to pay a proportional amount of taxes on the original account's pre-tax contributions and earnings. Let's just take a very simple example, because I need to break this down for you so everybody is on the same page here. Say you contribute $5,500 to a non-deductible traditional IRA. You also have a rollover IRA worth $94,500 from a previous 401k made with pre-tax contributions. Pre-tax, folks. Pay attention here. So in this case, 94.5% of any conversion will be taxable. And here's the math. So the total value of both accounts is $100,000. Pre-tax contributions, $94,500. After-tax contribution, $5,500. So if you divide $5,500 by 100,000, expressed as a percentage, you have 5.5%. 5,500, the amount converted, times 5.5% equals $302.50, and that's the tax-free part. And then you have 5,500 minus the tax-free portion, the $302.50, that will give you $5,197.50, and that part is subject to income tax. An important element to remember here is that if your 401k allows you to roll in an IRA account, as some do, you can essentially take your existing IRA out of the conversion calculation. Now, this should be part of a conversation you should have with your, again, folks. If you don't have a knack for anything investing, or retirement planning, please consult with someone who is qualified to do so to kind of help you work through this sort of backdoor Roth schemes here. Again, everything here is pretty legit. It's pretty legal. It just takes a little bit of intellectual exercising, some kind of financial exercising to be able to figure out what will work for you. Now let's talk about the fact that let's talk about the future of the Roth, the backdoor Roth. Some experts are saying that the backdoor Roth may not last forever. Is it true? Is it not true? Nobody can tell. Although this strategy has existed since 2010, the IRS has not officially commented or provided formal guidance on whether it violates the step transaction rule. What is the step transaction rule? When applied, this rule treats what are several different steps as if they were a single transaction for tax purposes. Experts from various horizons have mixed opinions on the likelihood of this happening, but the lack of a definitive ruling means that there is some risk involved, and you got to be aware of that. So if the Internal Revenue Service one day decides that the loophole is a violation, you might owe a 6% excise tax for overfunding your Roth. So if restrictions do come into play at some point, they could require backdoor Roth converters to pay a penalty, or they might include a grandfather clause. In the meantime, it's an option to consider if this is something you want to roll with. Roth conversions generally can make sense for many higher income investors with large amounts saved in a traditional IRA or 401k accounts. So having investments in traditional brokerage accounts, I'm talking here IRAs, Roth IRAs, as well as 401ks, can increase flexibility in retirement if you think about it, because you have a larger basket and you have different eggs in that basket. So if you use the backdoor Roth strategy, if you use this only to sidestep the earnings limits on Roth IRA contribution, please be aware of the risks and seek the counsel and support of a tax professional. All right, folks, this was it for today. I really hope that you enjoyed the conversation we had about the backdoor Roth. And if you're lucky enough to be in that higher earner bracket, please, this is great, and I wish you all the best. Please make sure that you enlist the help of a professional if you're not really familiar with the subtleties of Roth IRAs and the financial intricacies also of backdoor Roth. And I will see you next time. Until then, remember, stay marvelous.